Good morning, everybody. Good Thursday morning to you all. How's everybody doing today? Hope you're doing well. Nice, beautiful weather that we're having here in Muskoka, Ontario. Had a good session yesterday about the CFTC report. Hope you enjoyed it all. I had fun doing it. So, let me just start by saving my charts. Everybody can hear me okay? Yeah, I'm gonna do something here, make things a little bit easier. Good, nice to see you. Good morning, Jason. Good morning. Is it loading up? Oh, this one's taking a little bit longer than usual to load up. Just want to simplify my charts for today's session. We're still a little bit early. Well, it's just turning 9 o'clock now, so we still got people coming in. Nazar, good morning. Ali, Matthew, audio's good. Something happened here. Trading View got stuck, I guess. Let me fix this. Come on, Trading View. Let's get this up and running. So if you guys have any questions about anything that we've covered so far, let me know. And let me just bring up my charts back up since they disappeared. Alright, slowly coming up. Okay, let's try it again and see. Okay, now it's working. Alright, we are good to go. There we go. Good morning. Alright, so no questions, I guess, huh? Okay, let me just get my drawing tool. Good. Alright. Well, I wanted to do I wanted to talk a little bit about the market dynamics and how we can use what we see throughout the whole market to determine what we are to expect with price. Okay. Now there's a lot of people out there, a lot of analysts that are looking at gold right now, and they're making all sorts of predictions that price is going to be dropping like this on gold, expecting major drop on gold. So and they have all these fundamental reasons why gold should be dropping, right? So we'll look at the markets to determine whether or not that is likely to take place. I mean, from what we are seeing, we don't see that as even a slight possibility happening. And reason is, you know, if you look at the charts, right now we have an upward trend on the monthly chart on gold, and there's nothing to suspect that price is going to drop from here. Okay, The only time that we would expect that to happen is if this area of demand was to be removed and price was to drop. If this area of demand was to be removed and price was to drop, then we would consider a move lower down to here. Okay, but that hasn't happened yet, and until that does, there should be no reason whatsoever for us to speculate on price dropping down like this. Okay, that just wouldn't make any sense. As long as institutional demand is holding, we shouldn't expect anything different from price. Okay, so that's one thing. So to better determine if that is what we are expecting or not, we should also look at the rest of the markets. We can't just look at one market and make a price prediction on it. Okay, we can't forecast one specific asset without looking at the other charts. So when we look at gold, like I said, monthly chart, we are seeing nothing but upside. Okay, so let's move on. Let's go over to the dollar, because the dollar is also going to be very helpful to determine if gold is going to indeed drop. Now, the idea is that if gold was to drop, then we would expect a massive rally in the dollar. Okay? That's what we would be expecting, is a massive rally in the dollar. And what I can tell you is that we have major supply that has been contacted up here. Okay? Major supply has been contacted up here. And so you see that it was first contacted here, a second time, a third time, and then while price was contacting this supply for the third time, the institutions created new supply right here. Alright, so they came in, and not only were they reacting from an area of supply, they were making new supply in the market. Alright, so they were making new supply in the market. The only time they ever came in to make demand was down here. This is where they created demand. So they created supply here first. They dropped price. On the way up, they created this area of demand. They contacted the area of supply that they had previously created, and then they dropped price down to contact this area of demand right down here. Now, as price was dropping into that area of demand, what did they do one more time? They created an area of supply. So let me point out something that you should recognize here. 1. Major supply was contacted here. 2. New supply was formed here. 3. New supply was formed here. Okay? Those are 3 things I will point out. Now when we look at demand, this area of demand was created. So just by looking at that, what do you think is the more prominent zone? Is it supply zones or is it demand zones? What would be the more prominent one on this chart? Just by looking at this chart. I mean, it's pretty clear, right? Massive supply was contacted, new supply was formed, and again, more supply was formed. So we've got a lot of supply on this chart. And the only type of demand we have is this one demand here that's already been contacted. Alright? And now it's being contacted a second time. Now, one of the major differences between support and resistance and supply and demand is that support and resistance, when an area of support or resistance gets contacted multiple times, it is said that it's supposed to increase its strength. Well, we know that that's not the case. It may be the case at certain times, but over the longer period of time when you study support and resistance, you'll realize that there's no consistency in how many times a support or resistance area has to be hit to qualify as being strong. The reality of the markets is that when an area comes down, when price comes down to an area that looks as if it's support, the more times it contacts that area, the more weaker that area becomes. All right? So if you see all this supply coming into the market, and this one was contacted here one time, okay, just once, so I'll put the number 1 there, and then this one was contacted twice, right here and right here, and then dropped. All right, so the fact that it was contacted twice, and then it dropped, means that the supply from higher up was very strong. So strong that it enabled this area of supply here to hold extremely well, even though it was contacted twice. So price drops creates one more area of supply that has only been contacted one time, right here. And down below we have an area of demand that is not supported by anything on a higher time frame. Okay, I can tell you that because I've done the analysis on the higher time frames, and there's no demand to support this monthly area of demand here. So now it's been contacted a second time. First was there, and the second time is here. So what I'm observing by looking at this dollar chart is that supply is the dominant force here, and demand, the only one demand zone that there is on the chart, has already been contacted twice. That tells me that demand is under pressure and supply is the more dominant force here. So if supply is the more dominant force, then the expected move is lower like this. Okay? And so as we come down, we will contact this area of demand here. But over time, we could easily see price drop like that. Yes, could price rally from this demand? Yes, it's possible. But the key here is that we are expecting price to drop. So if we are expecting price to drop here on the dollar, and we look at that gold chart again, I mean, gold, the chart of gold is in a very, very interesting situation right now, because it has recently broke past the previous highs back here. It's entering into new territory in terms of the chart. Okay, and what we know is that the institutions created a demand area, an area of significant buying that enabled price to go into this uncharted territory. And now price is sitting inside that area of demand, and you see its reaction to the upside. So if an area of demand that was used by the banks to push price up into uncharted territories is now coming into play, and we see major buying taking place from here, then our assumption naturally would be that price will continue upwards, right? So remember when we were looking at the dollar, major supply in play, 3 major supply zones drawn on the chart that are in play, and a tested area of demand pushing up on price, but it's already been tested once. So if the dollar was to continue to drop, what do you think would happen with gold? Since the chart of the US dollar is pretty much showing that it's more likely price is going to drop than it rally, then what do you think would be the likely move here on gold? Right? Something like that. So just by looking at 2 charts, okay, not just one, by looking at 2 charts, we already build up the credibility of the move to the upside, all right, on gold. The likelihood of gold continuing higher just because we looked at one other chart becomes exponentially stronger. Okay? So that's just by looking at gold and the dollar, right? We can continue moving throughout the different charts and looking at the different assets. So that was the dollar. Let's take a look at the Aussie. Okay, we also know that the Aussie is very much in line with gold as well. We tend to think that if gold is getting stronger, then the Aussie will be stronger as well. And when we look here, what I can tell you is that we have a major area of demand here that came into play by the banks. Okay. Now, do you remember at the beginning of 2020, around March, there was a big scare and the Aussie dropped very, very hard. Look at that drop down to the 55s, right? Kind of reminds you of oil and what took place with oil. Massive drop, and then all of a sudden, over the next many months, price reverses and starts heading up higher. So we have the same situation here. Okay, so what I can tell you when I look at this chart is the one thing I see to the left of where price action is I see this area here. And when I look at this area here, one thing I can see is a lot of sideways action. We have a little bit of up, a little bit of down, a little bit of up, a little bit of down. Okay, but you see how all this trading takes place within a very specific range of price. And if you examine where price is currently, it's sitting within this range. I mean, if you were to extend these lines forward, you'd see that that's where price is right now. And I can tell you that when we have areas like this on the chart where there's a lot of trading that was taking place in a tight range, usually, not always, but usually when price gets back up into these areas, whatever direction price was heading in before it entered into this range, price is likely to continue heading in that same direction. Okay, so just by taking that information, we can conclude safely that price will likely over time head higher. So we have gold in an uptrend, demand that was formed, now in contact, will be very likely used to continue momentum to the upside. We have the dollar, major supply coming into play by the banks, and tested demand, which is weaker, likely going to continue lower. And we have the Aussie, and we see something on the chart that is pointing in the direction that price is likely going to go higher. So now we're looking at three charts, and they're all telling us the same story. Okay, the dollar drops, Aussie likely get weaker. Same thing with the euro and the pound and the kiwi. So just by looking at three charts, we already have a very strong picture being painted for us that gold is going to go up, dollar is going to drop, Aussie is going to go up. Now, if I was looking at this chart and I saw that there were, some major supply coming into play here and pushing price like this, then that would lead me to suspect that we're going to see a drop in price on the Aussie. And that would concern me if I was looking at gold and gold was exactly where it's in, sitting inside an area of demand. It would lead me to suspect that maybe that area of demand on gold was going to break. And if I was looking at the dollar monthly chart and I saw that there was a major area of demand that was being contacted like this, and let's say price continued higher like that, and then it created major demand like this, then I would have to reevaluate what I'm seeing on the charts, because now this would be painting a different picture. I would be seeing major demand coming into play here, and I'd be seeing major demand coming into play here. So when you look at multiple assets, you look at the supply and demand dynamic that is in play on the charts, and we have to determine what is likely going to happen based on what we're seeing. And if I was to be seeing this, I would not be anticipating a move lower on the dollar. I wouldn't be able to, because I would just be looking at this chart and I would be seeing that it's very likely that price is going to go higher. And I'm not basing that off of support and resistance. I'm not basing that off of Fibonacci retracements. I'm not basing that off of candlestick patterns. I'm basing it off of what the banks are doing. Okay? If the banks are so focused on creating demand on the chart, then that means it's likely going to go higher. All right? If they're focused on creating supply on the chart, then that's likely because price is going to drop. So there would be some concern if I saw, different things taking place on different charts that were going against each other. So if I saw a major demand being formed here on the dollar chart, then I'd have to really question myself with what I'm seeing on the gold chart. I'd have to make an assumption that it's likely the demand on the gold chart would break and price would head lower. So this is just a small example of how we use the different assets and how we examine the different assets and what price is doing on the higher time frames to determine if what we are seeing is in line with each other. Are they all telling us the same story or not? All right. Let me just take a look here. We got some questions from some of you. Kevin, do you consider rollover cost when holding a position? Sometimes, yeah, I will. Yeah. If swaps are expensive to hold a position long, then I will wait until momentum shifts to the upside before getting into a position, because I want to get in and I want price to move in my direction as soon as possible, because I don't want it to cost me that much money to hold that position, right? But if swaps are in my favor to hold a long position, then I will get into a position right when it comes into a major area of demand. I won't even wait for the momentum to shift, because I know eventually momentum will shift, so why not just get in early and start getting paid for holding that position open? So yeah, I'll do that. Let's see, how do we view the CFTC report in comparison to other pairs that are not shown in the report itself? Great question. How do we view the CFTC report in comparison to other pairs that are not shown in the report itself? So we don't need all the other pairs in the report. We don't need to have Aussie CAD, Aussie Yen, Euro Yen, Euro CAD, Euro Pound. I think Euro Pound's in there and Euro Yen, but Pound CAD, Pound. We don't need all those pairs. We don't. The reason being is because when we look at the COT data, what we're trying to get a real grasp of is whether or not the banks are accumulating a position or distributing a position. Okay? They're usually doing one of those. They're either accumulating a position or they're distributing a position, meaning they've already accumulated a position, price has rallied, and now they're getting rid of that position in order to do something else. So there are times in the markets where price will come into an area of supply, and based on the dynamic of what is taking place, there's a good chance that price will continue higher through that area of supply. So when it comes into that area of supply, in those situations, we have to determine, are the institutions going to fill in supply and drop price, or are they going to use this area of supply to take some profits on long positions, but then as price drops slightly, they'll reaccumulate more long positions and push price higher. That's where the COT report comes in handy, because the COT report can come in and fill those gaps of information that we don't know, because they're doing it live. All right, they're doing it right at the moment. So yes, we get the data 3 days later, but the 3 days later, that delay doesn't really work against us if you know how to use it properly. So if the data is suggesting that the dollar comes into this area of supply and it's going to continue higher, okay, then we know with some certainty that the dollar will be strong. Okay. So now we can look at the other dollar pairs to determine what will likely take place on those charts if the dollar is indeed strong. All right. So let's say the euro. If we're looking at the euro, if we know the dollar is going to be strong, the euro is likely going to be weak. So we'll look at the euro chart, euro US dollar, to determine where price is likely going to move to. So if it rallies up, where is the next area where we're going to get some resistance in price? Okay, so let's just quickly look at that. So if we know the dollar is going to be strong and we're looking at the euro, then that would suggest that price is going to drop, which means a weak euro. All right. So we look at this chart, we know the euro is going to be weak, so then euro pairs we want to sell. All right. So immediately we know that euro pairs we want to sell, but we want to sell the euro against the strongest currency. Right? We don't want to sell the euro against another currency that's strong. Okay, or another currency that's weak, I should say. We want to sell the euro against a currency that's strong. So how would you determine if a currency is going to be strong or not? Well, we determine that by looking at the overall markets to see if there's any correlation between, let's say, Aussie charts hanging in tighter and being stronger than all the other ones. I mean, recently we had the US dollar Japanese yen, okay, and it was months ago, I can't remember when it was, beginning of the year, right here, when price was hitting this area here. Okay, this was a major area of buying for the banks. We knew that, we had it drawn out as an area of demand, so we knew that there was going to be a very strong rally up in price here. So a strong rally up in price would mean a US dollar that's strong and a Japanese yen that was weak. And yet, if you looked at the euro, for instance, we saw signs that the euro was going to be a little bit stronger than what the Japanese yen was going to be. Okay, so remember, US dollar strong would automatically lead to the assumption that the euro is going to be weak. But at times, there will be certain currencies that will be less weak than others. And just knowing what currencies are going to be less weak allows you to trade the cross pair that will help facilitate a big move. So we had very strong moves in the euro yen and pound yen because euro was going to be stronger than the yen, and so was the pound. And so, when we look at the euro yen, we had this massive rally up in price like this. And we pointed this out, a while back. I don't know where it was, down here somewhere. And we said, watch the euro pairs. Watch the euro pairs because we're going to see a lot of strength in those pairs. And the reason being was because we were expecting the yen to get very weak. So looking at the COT data, it helps us to are the Aussie, the dollar, the euro, the pound, the Kiwi, the US CAD, US Swiss, and US Japanese yen. That's all we really need. Just by taking those and looking at the COT data, it'll help us to determine what is likely going to happen on those major charts. And then by knowing what is happening on those major charts, we can look at the other cross pairs and determine what currencies are going to be strong, what currencies are going to be weak. So that's basically, in a nutshell, how it works. That's why we don't need COT reports for every pair. It's not necessary. All right. So the euro yen was one of those pairs that we said watch it. It's going to fly. Pound yen was also one of those pairs that we said this is expected to get strong, and that was from down here, and So you see what ended up taking place. A very strong rally. Mostly, again, because we knew that Euro, Pound, Aussie, Kiwi, those were going to be stronger currencies versus the yen. And so the move up was to be expected. Okay? And we have one of our students that's actually with us right now in the room. He's working on a really incredible spreadsheet where he takes the COT data, he looks at the charts, he looks at what trends are in play to determine what are the strongest currencies and what are the weakest currencies, so that it gives him a better idea of what currency pairs to trade. So that is a work in progress for him, but it's looking pretty good so far. Gold is going to 1640. Gold is going to 1640. Okay. Gold is going to 1640. 1640. It's possible, but you're completely speculating right now, because there's no reason to believe that. No reason whatsoever. You could have your reasons, but I'm telling you right now, not based on what the banks are doing. There's no indication whatsoever that price is going to drop to 1640 from these highs. Not from what the banks are doing. Could it happen? Sure, anything can happen, but not likely. Not likely at all. And just based on the three charts that I just showed you. If there is more area of supply created, that means price should go up towards those supply zones? Not necessarily, no. No. Just because the banks create supply doesn't mean that they need to go up and contact that supply. The only reason why they would create an area of supply and then rally up to go into that supply is because they need to refuel and add short positions from those highs. But if you take a look at this gold chart here, all right, back in the 2013 area, the institutions created supply right here. Okay, but price dropped. Did it head back up into that area? No, it didn't. It just dropped. It didn't need to go back up to that area of supply. So it just dropped. So not every time when supply is created do the banks go back and then retrace up into those areas of supply. Let's see. Yeah, now it makes sense to you. Yeah, that's good. I get it now. Dollar drops and aggressively bought. Gold will get suppressed, in my opinion. Okay. Don't think US dollar is controlling gold. Make some research on Zurich gold pool. Don't need to do any of that research. Not saying the US dollar is controlling gold. I'm not saying that. What I'm saying is I'm teaching you that if you look at multiple markets and what the banks are doing with those markets, there are clear indications of what is likely going to happen with price for those assets. And I can tell you that if gold rallies, the dollar is going to drop. It's just going to work like that. Okay? Look at the massive rally that we had in gold. Okay? And look at this. The only reason why it went sideways for this period of time was because it was reacting to major supply. That's why. Don't get confused and say, well, it's going sideways while, gold was rallying up. So maybe that is telling us that something, different is going to happen. Maybe gold's going to drop and the dollar is going to drop. I would not say that. I would not say that. If you know supply and demand and you know how they react from, institutional areas of supply on higher time frames, you know that this is not out of the norm to see. All right, I'm just sharing with you what I know to be facts. I'm not giving opinions. I'm telling you what the facts are. That's the important thing here. I'm not doing analysis and telling you what my opinion is, because my opinion, what I just think is going to happen without having it backed up by facts, that is worthless. That information is worthless. All right. When you get an opinion from somebody who's not qualified to give you real analysis based on facts, their information is worthless. All right? I'm telling you based on my observations and what I know to be true about the markets, as a matter of fact, based in reality, based on how the markets move because of how the banks control the markets. That's what I'm sharing with you. Do with it what you will. Let's see. The best scenario is dollar index breaking 88 and reversing. 88.25 and then reversing. Yeah, it's a possibility that that happens. That's possible. But that's all speculation, whether it's going to do stuff like that. What I can tell you is just by looking at the dollar chart that it's likely going to drop down to here, the 87s. And then what it does from there, we'll have to wait and see. But to forecast any further after that move, it's just not high odds to do that. So I wouldn't do that personally. FX gold holic FX. I guess I need to check my charts again. Don't buy gold yet. Noted with thanks. Yeah. Gold holic FX. It'll happen for sure. Okay. Well, that's what a lot of people said about Bitcoin too, going to 100K. So I wish you all the best, but I'm sorry, Kevin, if you don't know where is most of the gold volume is concentrated. I'm a supply and demand trader to be okay. That's good. All right. So, any other questions? No? Okay. Good. So we'll move on. There was one question that I saw. Somebody wanted to take a look at. What was it? I don't know. Look, I'll tell you one thing, Goldholic. You remember Bitcoin? How everybody was saying, you know, all the reasons why Bitcoin was supposed to go to 100K, right? You remember that? How many reasons there were why Bitcoin was going to go to 100K? And we were saying that based on this chart formation here, it was likely going to collapse. So we're looking at the charts based on what the banks are doing, all right, with price. And if they're not holding certain structures, then that means it's likely going to collapse. What did we say? Price is going to go to the 33 area, and then that would be a good area to buy if I was to get involved in Bitcoin. It'd be like that for short periods of time, and if it started building up momentum, I'd have higher targets up on the chart. But this was based on reality, not based on speculation, not based on, well, I think it's going to go up because, you know, of all these reasons that are listed everywhere. You could just search it online and there's 105 reasons why Bitcoin was supposed to go higher. So there's good reasons to explain everything. But, you know, nobody cares about those explanations. If you want to understand where price is likely going to go, you have to follow the money. All right? And the money is the banks controlling the markets, period. There's no ands, ifs, or buts about it. You can think of it any other way you want to, but your results are not going to be consistent. I can just tell you that right now. You can go and figure that out for yourself, and many of you have already figured that out for yourself. I'm just sharing with you how the markets work. And you can have your own opinion. That's great. Will you accept the true supply if is 1936, 1940 if gold aggressively sell from off that level? Let's take a look back at gold. Will you accept the true supply? What does that mean, the true supply? 1936. The true supply. If gold aggressively sells off from that level. I don't know what you mean by that. Francesco Balducci. Kevin says Euro Japanese yen is rallying uptrend if I'm not mistaken. Yeah. So let's move on to the Euro Japanese yen. So what do we have here? We were looking at this a couple days ago, right? What did we say? Remember I said don't take my word for it? Remember I drew a trend line here. And I said that this was the explosive area that was used to take out the obstacles. And that explosive area, when price comes down into it, we could expect them to push back up from that area. Okay, so we're looking at the chart now, and what took place? Did we not have an area demand that came into contact here? And what is price doing right now? Is price rallying? All right. So again, I'm just telling you what the reality of the market is. Okay. I'm not saying Euro Japanese yen is going to drop, and then because the euro is going to come out, or the interest rates are going to be increased, or whatever, it's going to rally from this area. This is a good price area for price to reverse because of some fundamental reasons. That has nothing to do with why price is doing what it's doing. It simply does not. All right. So there you have it. Like I was mentioning a couple days ago, don't take my word for it. We will watch and see for ourselves, right? Well, there you go. And so that is working quite well. Let's see if there was a day trade off of there. Probably was. And here you go. Here's your day trade, okay? Let me draw it for you. Here you go. Who got into that one? Right there. Your entry was here. Your stop loss would be below. And it's already 3 to 1, probably 4 to 1. Let's see. 1, 2, 3, 4. Yeah, 4 to 1. Okay? Beautiful. The trade was given before it even retraced to the area. Okay? It was broken down right before it even happened.